Hey fellow investor, this is Mike Roux from Dividend Stocks Rock. How are you doing? Today I want to invite you to my latest webinar. Hey everybody, this is Mike Roux, founder of Dividend Stocks Rocks and Passion Investor. Must admit it's been a great summer, but I was looking forward to this webinar. It's been 3 months that I didn't do any webinars, so it's going to be very fun. This is normal, Peter. At the very beginning, when people are logging in, you're going to have a small delay in the sound and in the video, and then it's going to smooth out and everything will be fine. Yeah, so that's about it. Let's get started. Now the video is better. Today we're talking about, should you buy now? Should you invest your money right away? This is a two-part webinar series. Basically today I'm doing the first one is all about how you should invest your money today. And in the second part, which will happen towards the end of September, I will be discussing how to improve your current portfolio. So basically today we're really talking about someone who has lots of cash in their portfolio or about to fire the financial advisor and wants to get back in, or someone got scared and cashed everything back in 2018, for example, and now they're just wondering, how can I get back in? What's going to happen? So we're going to talk about how I actually used my own money to invest in the stock market back in 2017, kind of relate to that story. The whole purpose is capital preservation. Nobody wants to lose their money, obviously. And I'm going to offer a few, food for thoughts, counterintuitive strategy, things that you may not think of right now, and hopefully we're gonna start some great discussion over there. You're not here, big disclaimer, you're not here to get buy or sell recommendation. If you put all your money in the stock market after this webinar and we hit a Lehman Brothers case in October, this is not my fault. I cannot be taken responsible. You must do your own due diligence, do your own research. Make sure that you know why you invest. This is very important. But at the same time, you're here to get as much information as possible, learning from my expertise, learning from my experience, and some others are also sharing theirs in the comment section, which is pretty cool. For those who don't know me, my name is Mike Roux. I'm French-Canadian, so that's where the accent's coming from. So sometimes from time to time in the comment, you'll see me answering in French as well. I know that I have lots of regular like René or Roger that are coming from Montreal too. And there's one thing I want to let you know about me is that I'm passionate. My first passion is obviously my family. I have a beautiful wife, 3 amazing children, and I love them so much that I took a year off from work in 2016. I decided to travel the world with them in a small RV. So we drove all the way down to Costa Rica. So we spent 7 months in Central America, 3 months, included 3 months in Costa Rica, and then we went back. And when I came back, I decided to join 2 of my passions, which are educating people, seeing the results. I used to work as a private banker and financial planner, and my biggest reward wasn't my paycheck, but rather to see how people could evolve and improve their money investing styles and skills. And the other thing is obviously my passion for the stock market. Since the age of 8, I was fascinated by numbers. Already when I was a little kid, I thought I'm going to become an accountant. And when I hit my bachelor degree in the university, I started in accounting, and then I realized it was quite boring. And I didn't want to just align columns of numbers. So I went into marketing and then ended up in finance because I've discovered that working in the financial industry is so much fun. So I joined my teaching skills and my passion for financial investing in the financial market to create, to actually go full-time on my business, Dividend Stocks Rock. The business has been created as a sideline back in 2013. It's been almost 6 years now. We're going to celebrate the 6 years in December of this year. And the whole, it all started because I wanted to have a sideline, make money on the side, you know, just to go to Hawaii with my wife and have like a sports car and stuff like that. That was fun. But then when I came back from my trip, I realized that I really want to do that for a living. And because I want to spend even more time with my family, spending that year surfing, hiking, laughing, like 24/7 with those, I wanted to join my passion of traveling and then travel the world. So thanks to you guys, because I know a lot of you are DSR members already, we are going to spend 1 month in Vietnam in January. Actually, the whole month of January in 2020, we'll be spending it in Vietnam. So thanks to you guys. And yeah, so it's been a fun adventure. We're like over 1,000 members at DSR today. And it's been a great and fun adventure here. What happened when I quit my job in 2017, call my boss, say, hey, I'm quitting. So they were nice enough because I had a pension plan. They sent me over $100,000 as the community value of my pension plan. And then I faced a huge dilemma. Should I invest in the all-time high stock market? That happened in 2017. And it's kind of funny because back then in September, exactly 2 years ago, it was my first webinar. And lots of people were telling me, Mike, you should not invest right away. You should wait. You should cost average, you know, all those things, because it wasn't the perfect timing, right? Today, we're facing exactly the same dilemma 2 years later. And this is why I thought to do kind of like a refresh of this webinar and go a little bit further. Let's talk about what I call the elephant in the room is, should we invest right now after 10 years of bull market? But then I realized that some people tend to forget that even though we've been blessed by this bull market for the past 10 years, it hasn't been a smooth ride. As you can see, all the green circles right there are showing like more than 10% drop. And some people might have forgotten already, but in 2015, we had a down year. Like the market finished at like -1% or something like that. And it hasn't been a fun ride for Canadian investors as well. I know that roughly 50% of my attendees today are Canadian. And when you look at the orange line, the TSX just went up by 44% over the past 10 years. It's not incredible. And there's a lot of time that your portfolio didn't do much. So basically what I want to tell you here is, even though we've been having like a great success on the stock market for the past 10 years, it hasn't been that easy. And if you were waiting to get, you know, those small opportunities throughout this past 10 years, well, what happened is you just bought at a higher price than before in most cases. Even if you waited into 2018 when the market dropped by almost 20%, you saved maybe like a year and a half. That wasn't much. And that's a big problem. And now today, a lot of people are still in cash. The other half is most likely waiting for a good timing to invest. And this is exactly what happens all the time, because right now, what we're going to say is the stock market is overvalued, right? And I'm going to tell you something. I'm going to crash it down right away. Valuation doesn't matter. And it really doesn't matter. And I know you're going to tell me, well, Mike, that's the whole purpose of investing. You should buy low and sell high. That totally makes sense. I totally agree. But the problem that we have is there's no valuation model that works. You can use the discounted cash flow model, the dividend discount model, the PE ratio, all those things, they don't work. Funny enough, in 2013, 2014, I did a whole webinar on valuation, and then I went back in those 2 years, 2013, 2014, and most CFAs, CPAs, like financial media, portfolio managers, and what I'm talking about, like Bloomberg, Forbes, Value Line, Goldman & Sachs, they all agreed back then, like 4 or 5 years ago, that the stock market was overvalued by at least 30%, probably 40%. So when you think about it, the stock market was overvalued by 40% according to most professionals. And those guys, I mean, they have more brain power than you and me, and not because they're smarter, because they have access to like 10 CFAs working their ass off just to pull out research analysis. They have unlimited resources, and they cannot tell you that the stock market in 2013, 2014 was one of the best time to invest ever. They told you actually it was 40% overvalued. All that to say that the price you pay right now doesn't really matter, because you don't know how much you pay really, like you don't know the value. Let's look at the 52 weeks high story just for fun. I read a lot about investors telling me, oh, I'm not going to buy this stock or that stock because they're close to their 50 weeks high. Or on the opposite, some others will tell, oh, it's close to the 50 weeks low, so you should put your money into it. Well, let's take a look at this company. You know, I've taken the company name on this of this chart for a reason, but what I'm going to ask you, and looking at this company, it's up 50% in the past 12 months. It's close to its 50 weeks high. Do you find it attractive? Would you be tempted to look into that company a little bit more? Or you would be saying, oh, you know what? I just missed it. I just missed the party. Obviously, it's up 50% in the past 12 months, trading 50 weeks high. I don't think there's any place, any room for more growth, right? Is it like something attractive or not? Because definitely you need to go a lot deeper to see. And the stocks that I'm talking about is Disney. And funny enough, I bought Disney shares at 65 bucks. This is why I pull out this example back in 2012. Real life example out of my portfolio. And I wasn't a genius. I didn't know that the stock would double in value in the next 7 years. What I knew is I like the company. I like the expertise of acquiring content, creating multiple source of income from that content, and just repeating that recipe forever. They did it with Pixar, they did it with Marvel, they did it with Lucasfilm, Star Wars, and they recently did it again with Fox assets. And what I want to show you here is, while it was a very smart decision to buy at the 50 weeks high back then, you can see that between 2015 and nearly 2019, the stock was dead money for several years. It was going nowhere most of the time because investors were worried about what was happening with one of their largest income earner, ESPN. Basically, customers were cutting down cables, and now they were wondering like where Disney's going to find its growth or whatever. But just to show you that even though the stock doubled in value after being kind of like undervalued, if you want, it has a lot more growth coming up. But at the same time, it took a long, like for 3-4 years, you didn't make money. But just to show you that sometimes you have to be patient, and picking up stocks, whatever the value is, might be a good thing. Obviously, you should not overpay for stocks. Personally, I use the dividend discount model to give me an idea, because as investors, we like to feel good about in what we invest. We like to feel good about the trade that we are making, and this is the whole concept of finding the stock value before you start trading is about feeling good, about making sure that you're not losing money, and you know that it's going to go further. But in reality, we'll only know if today was a good price in 5 or 10 years. I wish I had money to invest in Microsoft at 13 bucks, like way back then, but I wasn't, But you know what's gonna happen in 20-25 years from today? The best deal will be today's price. No matter what's going to happen in the next 3 years. Because yes, the market could crash. It happened maybe 3 times over the past 100 years. So chances are that if you invest today, you're probably going to make money in 25 years. Now, you're going to tell me, Mike, I'm 60 or I'm 65. I cannot wait 25 years. Fair point. Keep in mind that if you invest today, and you're 65, chances are you're gonna live until the age of 85 or 90, right? So you still have 20-25 years in the stock market. And even better, probably that if you're managing your portfolio today, you probably have a good chunk invested, and this money is enough to probably pay for your whole entire retirement, and then you're gonna give something to your spouse or to your children or your grandchildren or a foundation. So you can still think for the long term, and you can still think going forward. What do you think is going to happen in the next couple of months? What are your fears? Where are you struggling? What do you think can go wrong? Paul is saying Trump. Yeah, election, Trump, lots of uncertainties here. Not going into politics, but in Canada, we have election this year. Next year, it's Trump. Obviously, Trump is trying to make the money, to make the stock market goes well, because he ran his first campaign on economic basis. Zero interest rates. Expect the market to decline because we're in a high bull market. Tariff trade war, obviously this never-ending war is crazy. So we have a lot of noise. Now let's go back in time just a little bit, just for fun. Imagine that, high government debt level, smaller than today, obviously, but back in that time, government were having difficulties. And then, I don't know if you remember the pigs, that was Portugal, Ireland, Italy, Greece, Spain, like 5 countries in the Eurozone that was on the verge of a bankruptcy. Like their bond yield was ridiculous. We were talking about 7, 8, 9%. I think even like Greece went up to like 12 or something like that. It was disgusting. We even invented the word Grexit because we thought Greece is going to bankrupt, collapse, and by collapsing, it would bring lots of banks with it. I don't know if you remember, but back in 2012, lots of Euro bank couldn't pass a stress test, meaning that if there's another shock in the economy, they would likely go bankrupt. And we all know what's happening during a financial crisis when banks are going bankrupt, exactly what happened in 2008, Credit is not accessible, and then the whole system where we live in, our whole economy freezes. And when it freezes, it's bad because companies cannot borrow anymore, so they're laying off people, and then people are not buying anymore, so companies has to lay off more people, and so on. And then we can think, oh, we're gonna base ourselves on Americans. You know, the American economy is gonna boom. But then, back in 2012, they were on the verge of a fiscal cliff, meaning that taxes needed to be risen and expenses needed to be cut, especially military budget, if you remember. So all those things were happening in 2012. A year later, 2013, remember, most financial analysts told you that the market was overvalued. And funny enough, it was probably one of the best timing, not ever, but one of the, like in the past 30 years, one of the best timing ever to invest. So first thing you should know right now, is you will find dozens of very good reasons to not invest at any single year. Back in 2017, when I got my money, first all-time high market. Debt was a concern. And then in Canada was a big thing. It was the NAFTA signature that was like going on and on and on. And it created a lot of problems and tariffs with Canada too. So lots of uncertainties over there too. So basically, fear is always be there. Now you have to clear that noise and focus on what really matters. And that's the number one step of my strategy, is to have a clear strategy. I know this sounds like investment basic 101, but honestly, I read like so many like investment thesis or strategy and stuff like that, that investors are kind of like forgetting why they invest in the first place. And I want to make money, or I want to preserve my capital is not enough. You need to know why you invest. What is your goal? What is your risk tolerance and sector allocation? Like, how did you went through 2018? Like, how much did you lose on paper? And how did you feel? A lot of people tend to panic when they're losing money. So first thing, write down your investment strategy, go back to the source of why you invest. And then what I decided to do on my side, I bought the Dividend Guy blog back in 2010. And between 2010 and 2012, I switched my entire portfolio towards 100% stocks, dividend growers. Why should you focus on dividend growth stocks? Mostly because in the history of time, when you look at stats and academic studies, there's a big debate between active and passive investment, right? So basically, lots of passive investors are saying actually, you cannot really beat the market. It's almost impossible for an individual investor to beat the market. And when we bring the dividend growers on the table, or the dividend yielders, because a lot of dividend yield strategy approach beat the market, they're saying, oh, that's because those companies are exposed to favorable factors that will increase the likelihood of beating the market. So we're talking about value companies, robust business model. So companies that are leader in their market, strong R&D budget, great expertise in acquiring other companies, integrating them in their business model, competitive advantage, great brands, and so on. And those companies are increasing their cash flow. So thank you for being there. I had a lot of fun. It was great. After 2 months, I kind of felt like rusty at first, but yeah, so in about 2 weeks, look out for my next one. Will be how to improve your portfolio. So now we're going to look at an existing portfolio and how to manage it to make sure that you don't get hurt. So this is what we'll be talking about in about 2 weeks. We'll talk to you soon. And in the meantime, don't forget to stay invested.